Hello, good morning. Well, my name is Aili Ong, and as I mentioned, I work in Bloomberg in London. I'm not a news reporter, so you can feel free to talk to me. I wouldn't quote you all. I'm an analyst in metals and minings and equities. We are very delighted here this morning to have four very well-known and expert on gold to discuss about signs of new bull market for the metal. Right, I'll just wait for you to settle. Right, we have seen some hope since last year, especially during the time of the Brexit referendum results and the US presidential election, where gold price actually gained some momentum. But this year, we've seen the gold price had a slight breakthrough over $1,300 an ounce, but been trading around $1,250 to about $1,300 so far historically. So let's start with the first question to our panels. Where do you think we are in the gold cycle today? Shall I start with Doug?
Sure. Thank you. Thank you. I think it's interesting. Where are we in the gold cycle? Clearly the last several years, 2013, 14, 15 were difficult. 16 was quite a reprieve from the tough markets we saw in the early part of the decade. It looks like we're in the beginning of a very extended cycle. We saw the mining industry contract. They cut their costs. Certainly gold prices have tested a bottom. Now we can look at that in the past and say, hey, 1050, that was the bottom. That was the cost of production at that time for the industry. I think what's interesting is we had the gold price breakthrough, as you point out, at 1,300 earlier this year. Almost to 1,350, and then it came back down to 1,200 in July and quickly bounced off that price level. And from there, it came back up here to 1,300, 1,290, 1,300. My perspective is that the all-in corporate cost of production is about $1,250 an ounce for the industry. And so fundamentally, we're at a support level at $1,250, $1,225, $1,250. Now, certainly some miners are able to produce at a lower cost than that, but that seems to be the support level. And the market is aware of that. If you look at pricing as set by the futures market, they're aware of that. Mm-hmm. And yet, with the past that we've seen over the last number of years of declined investment, we're going to see a decline in production at the end of this decade and the early part of next decade. To get more production, we're going to need higher prices. And we're hedging up there. We're edging up to 1,300. I would expect next year we're going to retest last year's price level of 1,370. I think $1,400 is an important level. I expect to see that in the next 12 months. As far as the cycle goes, I would expect that we're into a long-term 5-7 year trend on the sector as the sector has consolidated significantly. So I think we're in a really constructive mode. I think what's also fascinating is there's not much interest in gold right now. Certainly there's a lot of people here in the room that are interested in the sector, but really the equity markets, bond markets, real estate, Bitcoin are taking investors' attention. And that's a great thing, I think, in terms of investing opportunities for the market. Valuations are not extensive.
Right. Aegon, as a managing partner at Marathon Asset Management, do you agree with Doug's view at Tocqueville Asset Management?
Yes, I do agree with Doug, but we look at it from a different perspective. Is this on? Can you hear me?
Yes.
Yes. We are really specialists in wealth preservation, and we are totally into physical gold rather than the mining stocks. So we buy physical gold for investors to store outside the banking system as insurance against what we see as potentially very difficult times in the world and destruction of continued destruction of paper money. So if you look at the cycle turned in 99 or bottomed in 99, and we are in an uptrend. It's been a long pause, a very long pause since 2011. But the uptrend is intact, and that uptrend is going to go on for many, many years, whether it's 5 or 7 years or longer, because it will be a reflection of government's continued destruction of paper money, of course, and that is guaranteed to happen. So, what gold will reach or how long it will go on, nobody knows. But in our view, gold is going to be at least 10,000 in today's money and maybe 50,000 just because of what's going to happen in the world. And when the paper market finally collapses and the manipulation of gold ends, then of course the paper holders of gold are going to try to get delivery, and they won't get delivery. And at that point, gold will just go up, in my view, faster than Bitcoin is going up now. I'm not a gold bug. I'm not somebody who thinks that gold is the only solution to the world's problems. For us, gold is just insurance against a world which is in a total mess financially, economically. So that's how we look at gold.
Okay, Mark, as an investment manager at Charteris, do you also share the view of the 5 to 7 year longer, what Egon and Doug say in the gold cycle?
Well, we're sort of got both really, because we were investing in gold mining stocks like Agnico Eagle around 2001. So we've been a believer in the gold bottoming when it was around 350, 400 around that time anyway. So we've been a long-term fan of gold. But to be a bit more, to go back to the 5-7 year, we agree that it was around the bottom 2 years ago, 1050. We're going to be entering a new exciting phase in gold over the next couple of years. We're really looking forward to seeing how powerful the gold price can be over the next couple of years.
Mm-hmm. And Thomas, do you agree this new exciting phase that we're going to go in for the gold market?
Yeah, obviously, I'm also, like all of us, you're probably bullish for gold, but I look at it like Aegon from a slightly different perspective. I compare it to the bull market in the 70s, and I think right now we're at the beginning of the second phase, which is going to be much more explosive than the first phase. So the bull market really started in 99, 2000, and what we had over the last couple of years was a typical 50% retracement within the uptrend. Gold went to almost 2,000, came back to 1,050. So it was almost a 50% correction, just like you had in the 70s. Between 73 and 74, gold went first from $35 to $200, then back to $100, and then to $800. And the beauty about this coming up leg is that it's going to be more explosive than the last or the first 12 years, where central banks allowed the gold price to go up 10-15% per year, but never allowed it to really make headlines. But like Egon said, sooner or later, the manipulation will collapse, and I guess that's going to happen in the next 2-3 years. And then eventually gold will have to be trading at a real level to re-inject some credibility into the rotten Western financial system to basically completely reset everything. Mm-hmm. And that will have to be a 5-digit number, $10,000, $15,000, whatever.
Mm-hmm. So Thomas, as your role as managing partner at Charteris Royal Holdings, how do you see gold fit within a multi-asset portfolio? Shall we start with
Yeah, I must say, Cartesian Royalty Holdings is a streaming royalty company. So as a company, we're officially agnostic to the gold price. So what I'm saying here about gold is my personal opinion as yes. Within Chancery. And we are totally focused on gold. So we're focused on precious metals. So for us, gold, silver is pretty much 100%.
Mm-hmm. So even from your own portfolio in the business. And how about Egon? What do you think for the multi-asset portfolio?
I think I'm the wrong person to ask you. We
let's have a view.
But I'll tell you my view. In 2002, we decided that there's going to be a mess in the world, and therefore you needed to own physical gold. So we went in then for ourselves and our investors in 2002 at $300 then. At that time, we said that you got to have at least 25% of your assets in gold. But you have to understand that I look at this from the point of view of wealth preservation rather than from the point of view of making maximum gains, because I think that there is a risk that the financial system will not survive. Or if it survives, it will be with money which will be worthless. And therefore, we're using gold, as I said before, as insurance. You hold gold as the insurance against a world which might or might not look the same in a few years' time, economically, financially, and therefore physical gold acts as insurance against your other assets. Saying that, I think a lot of the mining stocks will go up, substantially, and some even exponentially in coming years. But it's a different risk because if you don't hold them directly, your investments, you are within the financial system, and this is why, from our point of view, as wealth preservationists, we think that you should hold gold outside the system. So that's, as I said, I know that when you're talking about a mining conference, is the wrong approach. But nevertheless, I think the insurance will be necessary, and I think investors should be very careful in coming years. But, everything has a place in the portfolio, even Bitcoin, which we think is a bubble. But bubbles can grow a lot bigger until they burst, which we have seen throughout history. But this is, I'm sure that the mining, especially gold mining, silver also, that will become a bubble also. And a lot of people will make a lot of money as long as the system functions.
Right, so wealth preservation up to 25%. What do you think, Doug?
Thank you. It's interesting. Gold is so many different things to different people, different cultures. And that's kind of the beauty of gold, whether you consider it's money or insurance or an alternative to investing opportunities. What we recommend typically, and it depends really upon your own position, about 5% of the portfolio should be exposed to gold, whether it's gold mining stocks or gold equity, gold bullion or coins or what have you. The beauty of gold that we think offers investors is that sense of diversification and as a non-correlated asset. I think that notion that gold is somewhat out of the financial system offers you that sense of insurance or that sense of preservation of value that you won't get being within the system, within equities or bonds or whatever's popular in the day and age. So, I think, yes, you have to have exposure to gold, and whether you do that with bullion or coins or you keep it in a safe deposit box, yes, have gold as a part of your overall portfolio as a means to offset some of the events that might occur in the world, really as a non-correlated asset.
Mm-hmm. Mm-hmm. Thank you. And Mark, can we hear your insight? What do you think the percentage proportion of gold do you think should be in a multi-asset portfolio?
Gold definitely has its place, for sure. If you've got a portfolio where you've got zero exposure to gold, that's definitely wrong in our view. Historically, most people have maybe had 1 or 2% exposure to gold, whether it's through the physical or through the mining shares. We would say maybe 5 to 10% at this time, but if we're correct and that the gold price is going to be experiencing an exciting phase over the next couple of years, that percentage will not only gain because of the capital gain, but it will also gain because clients will want more exposure to gold assets, and the demand will return. So that's probably where we are at the moment. But to have zero exposure to gold and other precious metals as well, sort of silver as well, would be incorrect in our view.
Mm-hmm. So it's interesting, Doug, you mentioned about gold being an asset that can diversify against risks. One of the things we notice about the gold market is that when we look at gold's volatility over the last 12 to 18 months, it's relatively low compared to its previous peak when you compare 2009 to about 2013. So can we see gold still having a role in hedging like volatility against like other assets or commodities, and also potentially boosting returns for investors?
I think within a portfolio, a well-balanced portfolio, certainly, its non-correlated features really offer that to an investor, and it really depends upon an investor's overall portfolio, of course, how much bonds they have, equities or real estate, etc. So yes, I mean the notion that gold is sort of outside the system really offers that attribute to diversification.
Right. And Mark, you mentioned about 5 to 10% of gold being in a portfolio, do you also see that it has a role in hedging volatility and maybe boosting the returns?
Well,
your portfolio?
for the fund that we manage, which was the best performing fund in the UK last year, went up 133.95%, best fund in the country. So, and we're a long only fund. There was no hedging, no shorting in place at all. So we're of the view that if the price is going to go up, if we're in this exciting phase, we shouldn't be looking to hedge or to short gold in one of the most exciting phases. So we're long only. We're probably not going to be looking to short or to hedge gold, either the price or the mining shares in any way at the moment.
And Aegon, you were referring gold as a asset for capital preservation. So in terms of the time frame for the volatility hedging and boosting return, do you also see that that will also play in terms of the metal's performance?
The gold is, it's not always a hedge, of course, or it's not always a necessary hedge. Gold is definitely something that you should own a lot of when the world economy and the world financial system is totally mismanaged as it is today. All governments in the world run massive deficits. All governments, world debt is growing exponentially. It's almost doubled since 2006, and the world is still in a mess. And during those times, you have to own gold. Now, gold has been kept down, in my view, because of manipulation. A lot of people say that that's not true, but you could just see when the price dumps and billions of paper gold is dropped on a Friday night when every market is closed, or on an early Monday morning in the Far East. There's no commercial seller who would ever sell gold into a market when there's no buyer. So it's clearly manipulated in a major way. So that's kept it down. As long as the paper market functions, they've succeeded, and that's why the price is artificially low. And that, in these times you should hold gold, but there are times when the world economy is properly managed, when governments are not running deficits, and then you don't need to hold gold, of course, because then gold is insurance, and you insure it against when you see the risk being elevated. Right now, I see risk, the red flags everywhere, in my view. That's why anyone who doesn't hold gold, I think, is irresponsible. But I know that everybody won't agree with that. Probably many people around here in this room.
Thomas, so do you also share Aegon's view of once you hold gold when the world is mismanaged to hedge volatility and boost returns?
Yeah, I don't consider gold as a hedge in a sense that most people talk about hedging these days in a financial engineering sense, because one of the frustrations and one of the arguments of some people why gold doesn't work anymore as a hedge is that the world is going completely out of control, and central banks print more and more money, and the gold price is still where it is because it's manipulated, which of course is not allowed to be told in mainstream financial media. So I don't think gold works as a hedge when, let's say, the Dow drops 1%, gold goes up 1%, or in that sense. But I agree with Aegon that you should have gold as a hedge in a traditional sense, as an insurance for if and when something really bad happens, because sooner or later the manipulation will no longer work. And that's when you need to have your gold. And it's going to be too late to buy it then. You need to have it before.
I'm sure you heard before this, when you buy fire insurance, you don't buy because you hope that your house will burn down. But when it does, it's good to have the insurance. And it's exactly the same way we look at gold. When gold goes up the way that I think it will do, the world will not be as nice to live in as it is today. So, sitting and hoping for gold to go up has severe consequences for the world. But that's the same as fire insurance. You know, when you need it, your house is not there anymore because it's burned down. And this is the way we look at it. Not so. You know, I agree with you. It's not a hedge that you can actually just hedge a normal portfolio. Certain times it is. As we know, for the last 6 years, it hasn't been at all. It's been a very poor hedge. But I think for the next 6 or 7 years, it'll be the best hedge you can ever hold.
So the panelists are saying that we should buy gold as an option, as insurance. So here's a question I think most of us wants to know, like, where do you see the greatest return, or where should we buy gold? Should we look at the explorers, the mining producers, the physicals, the buying coins, or ETF? Shall I start with Doug?
Sure. You know, I think there's different opportunities in different segments of the gold market. I think that, you know, certainly bullion holdings are a means to ensure your overall wealth, a store of value. So that's one aspect. And so you have to kind of think about, what is it I'm trying to achieve? Gold equities are a little bit different. I don't really think you want to go to gold equities as a means to ensure your overall portfolio or to diversify necessarily. Gold equities offer upside that is a little bit more unique than the gold bullion holding that you might hold. Gold equities, you know, the way we see it, are companies that are creating value from discovery or producing gold or doing unique transactions, M&A transactions. So it's in investing from a different perspective. It's a little bit more dynamic. So I think you have to think about it in a different way and say that, well, look, I have my gold bullion for insurance. I'm investing in gold equities, gold mining stocks, for an opportunity of value creation from discovery or production. And in that regard, I think that if you look at the explorers and developers, they're the ones at the front line of creating value most quickly and initially. Now, I say quickly because, and I have to preface that and say, it can take a long time for a discovery to play out, so it's not quite so quick, of course. But the producers are creating value over time from the cash flow they're generating. So it's a really different type of concept that you have to think about. As far as gold ETFs, here they're perhaps more of a substitute for that gold bullion exposure. It's maybe not as direct a way to have that insurance, but it is a form of insurance. It's a means to allocate some capital, to have maybe that assurance that you do have gold exposure and you're participating in the gold price, but it's perhaps not quite as rock solid as having your own gold in your own vaults or your own lockbox or what have you, to offer that certain insurance that you would want to have. So I think you really have to think, what is it you're trying to achieve, and then allocate your capital according to what you're trying to achieve.
Aegon, you not as well?
I would agree with everything you said, Doug, absolutely everything. So I have nothing to add to that. I think you're right.
And Mark, what do you think?
Well,
any favorite?
Favorite? Wow. I mean, for the fund that we manage, we're in the producers as opposed to the explorers. I mean, from our perspective, there are sort of 3 big pros for the producers, which is, one, they could make a discovery, which is always exciting for any gold producer. They could start paying a dividend, especially if the gold price starts going up, which could attract some income investors to that particular stock. But then there's also M&A. We've seen that over the last 2 years, that there's been quite a bit of M&A activity. So there's 3 sort of bullish stories. But to caveat that, there's always company risk. There's always the fear of mismanagement. There's always the fear of fundamentals and the balance sheets going haywire. There's too much money has been spent on capex historically. So there's always those risks involved. Storing gold bullion is preferred by some people as insurance, as my fellow panelists have said. But there are costs involved in that. There's storage costs, there's insurance costs in that. There's security and all that sort of stuff involved in that as well. So for the fund, we're looking at producers, but it's certainly not a bad idea to have have coins, to have physical on you.
Thomas?
Yeah, again, it depends why you buy gold or invest in the sector. If you want portfolio insurance, you buy gold, and then the main thing is to have physical gold. Don't touch ETFs because they will turn out to be worthless when you really need the gold. So you should always have a physical gold component in a portfolio as an insurance. And because the gold price currently is still artificially suppressed because of manipulation, there's also a very compelling investment element to invest in gold. Normally, I would say gold is not something that you invest in, but you just keep it as wealth preservation, as Aegon says. But because the price is artificially low, you can also probably make 5, 6, 7 times your money in physical gold, just holding it until the price goes to its intrinsic true level eventually. And then the same goes for silver, which I like even more than gold. Some people call it gold on steroids. And the same arguments for gold hold for silver as well. But I guess the reason why we're all here and look at mining companies is that fundamentally, ceteris paribus, the mining companies are operationally leveraged to the gold price. And so if the gold price goes up, everything else being equal, the profits and the share prices of the mining companies should go up 3 times or much more in the case of juniors and exploration companies. And I guess that's the excitement we all look for when we invest in gold, explorers and producers. So that didn't really work out in the first part of the cycle because while the gold price was going up, mining costs also exploded and a lot of companies were badly managed. So the leverage, the operational leverage of the mining companies didn't really work out. But now the sector has restructured, and you can see again the market likes junior producers, but exploration is coming back again. And I'm sure throughout the cycle in the next few years, we'll have spectacular exploration stories again where companies make a discovery and share prices go up 10, 50 times.
Mm-hmm. So I've got a few more minutes, so I'm going to squeeze in one question. So we all want to know where gold price is going to be. So at Bloomberg, we see the gold futures this morning for physical delivery, for the metals delivery going up to $1,400 an ounce by 2021. And the Bloomberg consensus of analysts forecasts the price to just below $1,380. So I'm sure the audience would like to know, where do you see gold price next year, if you can say, or give a range? So we start with Doug.
Sure. Well, I think earlier I kind of commented that looks like there's good support at 1250 or so, 1225. Okay. I would agree with that 1380 type number is a good objective over the next 12 months. I think that you're going to see you'd see a breakout at 1400. You're going to get a lot more attention in the gold space if we get to 1400. I would not be surprised if we saw that price in the next before the end of next year. Mm-hmm. And I think as far as the next decade, I think that's much too low a price. I think we're going to see in 2019. I think we're going to see an explosion in prices as the market recognizes a couple things. First of all, it's hard to say when this overall equity market, bond market is going to top out. Maybe it's next week, maybe it's next year, but I think as the U.S. administration goes through its stages, you'll see that a shift later part of the decade in 2019, and the market in the world will shift, and you'll start to see investors recognize that they do need to have alternatives. And gold is so out of favor right now, you're going to see a rush into gold, and I think you're going to see a real breakout in 2019 and 2020. And from there, I think we could see $1,600, $1,800 an ounce.
Thank you. Egon, you see support at
Yes,
50?
well, gold in dollars bottomed, or the correction finished at the end of December 2015. But remember that we're all talking about gold in dollars and the price in dollars, which is irrelevant for most of us sitting in this room if you're not Americans, because gold should be measured in your home currency. So you look at a sterling investor. When we had a number of sterling investors when we bought gold in 2002, and gold was £200 an ounce in 2002, and today it's just under 1,000. So that's 5 times, and that's clearly better than any stock market during the same period. And then you have, so in many currencies, gold bottomed a lot earlier, 2013, for example. And then, of course, you have the really badly managed economies, whether you take Argentina or Venezuela or whatever, then you see gold just flying to the sky. So don't think about gold in dollar terms, because that's a fallacy. But people are lazy, and we all are, because that's the only price that's quoted anywhere. In Switzerland, you actually see very often gold price in Swiss francs per kilo rather than in dollars per ounce. So, but I think it's totally irrelevant where the gold price is in 2018 or 2019, because the trend is going to be up, and this is a longer trend. It's a trend reflecting what's, as I said before, what's going to happen in the world. So don't focus on next year or the year after. Focus on that. Gold, sadly, will reflect what's going to happen in the world, and whether that's, as I said before, in 2002, I already projected that gold would go to at least 10,000. I think that's very low. I think it'll go to 10,000 in today's money, maybe a lot higher than that. But I also think that there is a very high likelihood of hyperinflation. And then whether gold will be 100,000 or 100 million or 100 trillion, like in Zimbabwe or like in the Weimar Republic, that's, of course, irrelevant. Those series don't mean anything. But what it means is that you have actually still got purchasing power with your gold, that money, when money will be worthless. So gold preserves purchasing power, and whatever is the price is in hyperinflation, that's not the money you've made, but the money you made is that is an insurance against all the money you will have lost on all the normal assets in a hyperinflationary period. So therefore, gold should be, I think we're coming back to the cycle, whether it ends in 21 or 25, we will know in 10 years' time when we sit here, if we're still alive, some of us.
Okay, quick.
But then, so just have patience, sit on it, don't worry about it. The time when gold will peak is the time you can't sell it, because there'll be no financial system to sell it into. So you're not going to sell. So, but what you can do is, of course, swap it or barter it again. That's what's going to happen. You'll barter it against assets for nothing, basically.
Thank you.
Sorry.
We're running out of time. And just quickly, Thomas and Mark, longer for the metal?
I'm not too sure I can follow that.
Okay, and 10 seconds, Thomas?
Yeah, I also don't focus on next year.
Okay.
The trend is up, and whether it's going to be 1360 or 1400 or 1450, I don't really care.
Well, thank you so much for our panelists here today to discuss about the new signs for new bull market for gold. Thank you.